Hi everyone, welcome to this webinar on trading with OrderFlow. I see that many of you have joined in the past as well, but we will be covering this topic again for those who are attending the webinar for the first time. So let's start with the concept of OrderFlow, and then we will give details about what exactly is OrderFlow is all about, the terms that are used in the OrderFlow, and then we will go into the trading setups. And we will discuss in detail even the today's trading session, and thereafter we will have a question answer session. This time we will do a little differently, where we will ask you to you can ask questions. We will ask you to unmute the mic, and then you can ask questions so that everybody understands this in detail. So let's start. So as you know that we are going to discuss about the introduction to OrderFlow charts, different terms that we're going to use, that we use in the OrderFlow analysis, trading setups that can be used for OrderFlow analysis, and question answer session. So what is OrderFlow? OrderFlow is a technique that analyzes the behavior and intentions of aggressive buyers and sellers. For any trade to execute, either buyer must buy at the best available ask price, or seller must sell at the best available bid price. I think many of you joined in the past. This concept is very clear now to you guys, but those who are not, those who are attending this webinar for the first time. So let me give you a detail about what exactly the aggressive buyers and sellers are. So aggressive buyers and sellers are those who are buying at the market, okay, or selling at the market, okay. Along with that, there are passive buyers and sellers who place limit orders. Like say in the case of limit orders, we know exactly what price we want to buy or sell, and that's why we place a limit order, or to get a bet. Like we when we buy at market, we don't know what price we are going to get it. So we want to ensure that we want a particular price, so we place limit orders, and these are called the passive buyers and sellers. Okay, so we will discuss the importance of aggressive buyers as well as importance of aggressive buyers and sellers, and the importance of passive buyers and sellers as we go through this webinar. So just to look at the charts here, you can see on the left side of my screen, you can see a candlestick chart with 3 candles. Okay, so they show us how the price has moved in a particular interval. So if you look at the first candle, the market opened here and went to a high here, went to a low here, and closed here. Okay, so you can see the middle part of this middle section of this particular slide, where you can see that the same chart is divided with the volume traded. So on the left side, you will see that all the aggressive sellers who sold at the market, the volume is divided out here at every price point. And on the right side, you see the volume traded by the aggressive buyers. Okay, so highs and lows are the same. You can see that there is a wick in this particular candle. So similarly, if you see the second candle here, the open was at this price, close was at this price, high was this price, and low was this price. So many of you understand what this candlestick chart all about, and what we show in the order flow is the same thing, but the information about volume is divided into multiple clusters, and we will get to know how exactly the volume market has traded at different price points, and what kind of a volume that has been occurred on that particular levels. So on the right side, you see there is a time and sales window where we will record all the ticks that are traded, and with every tick we mark whether the trade was done at a bid price or ask price. The concept is very simple. We just look at whether the current trade was above the previous tick or below the previous tick. Okay, so if the current trade is below the previous tick, then we consider the trade was done by the aggressive sellers at market. And if the current tick is above the previous tick, then we consider the trade was done by the aggressive buyers at market. So, I mean, of course, there are other ways to look at this data as well. However, the kind of a data that we get from the data vendors or the exchange from the exchanges through a broker terminal are not tick by tick data. So when I say tick by tick data, what we get is a snapshot data. So based on this, this is what we can get the best information. So if you have if we get tick by tick data from the exchanges, probably we will be looking at even the best buyer and sellers at every price points, and that can also give you additional information. Um, but for the time being, I think this is good enough for anybody to understand who are the aggressive buyers and who are the aggressive sellers, and how that has been plotted on the charts. So let's look at who are the passive buyers and sellers. So passive buyers are these like who are placing limit orders at different price points. So you can see that there are 3,167 shares to buy at 129.35, and there are different at every price point there are buyers, and every price point there are sellers. Okay, so these are the people who provide continuous liquidity to the market. So at any given point of time you want to buy, there is going to be a buyer or seller available because of these passive buyers and sellers. They have a definite plan where to buy or where to sell. Not necessarily that they want to buy or sell at that particular price, but they want to do not want to get slippages when they are trading. They want to execute a price at a particular price level. So that could be one of the reason. But many a times, big institutions do not place market orders. They place limit orders and try to execute the limit orders in smaller parts. Remember, what happens in a market. Institutions do not want the price to be influenced a lot uh, by their orders. So what they do is they place smaller quantity orders at every interval, by iceberging the order or time splitting the order. So they use different algos to execute these orders, and most of the time they place limit orders. Okay, so what happens with this is that we know that there may be institutions buying and selling, but we don't know what price they're buying and selling. However, we can at least identify that there is somebody selling or buying in huge quantities. So what happens is that when a trade takes place, the price can be hidden. Like, when you place an order, you can hide your prices. Even as a retail investor, when we're placing the orders, we have the option of placing disclosed quantity. But what you cannot hide is the quantity traded in the end. So we will like that gets reflected on the charts, and that's what we are looking at, how to identify this kind of a volume, how they're influencing this volume towards the price direction. So identifying these limit orders in an order flow is possible. One of the concept that we have developed is, which we already discussed in the past for some of you, where we can easily identify whether there are big limit orders or buy or sell limit orders sitting on the market order book, trying to execute these orders. And a big yeah, we will show you how exactly these orders limit the price movement in a particular direction. So let's look at the order flow chart itself, like in detail. So what are the things that we need to look at? So total volume is the volume that is traded in an interval. So you can see here the volume. Okay, if you look at the last bar that we are looking at, okay, so you can see 3,972 lots traded in volume in this particular interval. Buy volume and sell volume. So if you look at the left side of the order flow chart or cluster chart, all the volume that is traded on the left side is the sell orders executed by the aggressive sellers, and on the right side all the orders executed by the aggressive buyers. Okay, so the point of control is where maximum volume has happened, and that is highlighted in yellow here. So you can see that every bar will have, every cluster charts or every order flow chart has a point of control highlighted in yellow here. Then there is delta volume. Delta volume is nothing but a difference between a buy volume minus the sell volume. So if the buy volume is more than the sell volume, the delta is positive. If you look at in this particular candle or bar, you can see that the delta is 204. So that's nothing but 2088 lots minus 1844 lots. Then max delta and min delta is the movement of delta from the start of the interval till the end of the interval. This will give us some information which we will discuss in the cumulative delta chart. And cumulative delta is the delta accumulate on a cumulative basis. So you have the option in Quantower to choose whether you want to choose the delta cumulative delta calculation based on the start of the day, based on the start of the week, or based on the entire data that is available on the chart. So all these all whichever point that you take, you will get an idea that how exactly the cumulative delta is moving, whether the aggressive buyers are in control or aggressive sellers are in control. Then imbalance buy sell. So you can see that there are certain values which are highlighted in red and green out here. Okay. So we look at these values diagonally. So if you look at the first candle, you can see 38 versus 256. So 256 is the sell aggressive sell volume at a particular cluster level, whereas the 38 is the buy volume level. So if it is more than three times, we highlight that as an imbalance and we highlight it in red. So similarly, on the right side here on this particular chart, here you see 55 versus 327, which is again three times more. So we have highlighted the buy side is more, so we have highlighted in green out here. Then there are stacked imbalances. So if there are more than three consecutive imbalances on either side, we will highlight that in red or green as a resistance and support line, which you can see it in the chart as we go along with this webinar. Then there is delta divergence. So anywhere when the delta divergence is nothing but if you look at this particular bar, the center bar that you are looking at, you can see the delta in this bar is negative 985 lots, whereas the candle is positive. So basically, it tells us that there is some kind of a confusion. There is a delta divergence. So delta is negative, whereas the candle is positive. So that is called delta divergence. We'll discuss that again in detail. Again, then comes the ratio high and low, which you can see on top. Ratio high here, which is 11.44, and ratio low 4.59. So we will again discuss. This is a very important level. This is a proprietary information. We will discuss this in detail again as we go along. So let's okay. So as I said, there are different setups that you can look at. One is based on the point of control. Second is based on stacked imbalances. The third is delta volume, and then cumulative delta and ratio high and ratio low. So let's quickly go into the chart, and then we will discuss this topic one by one. So let's go to the chart once. So all those things are marked by me, so just ignore that for the time being. We will discuss that in detail. So the concept of point of control. Now, what happens? How to look at point of control? Okay, so let me give you a brief about it. We will have a detailed discussion at a later stage, uh, and we will see how exactly we can train you on using OrderFlow charts. So let's look at the concept of point of control. So let's start with the current day itself. So you can see that the market started around this level. Okay, so you saw a market forming a point of control lower. Okay, again market formed a point of control at the same time, same prices. So we can assume that market is finding a value around these levels. So these are the levels that if it is continuously forming downwards, which means the trend is continuously going down. So if you look at 2 or 3 consecutive point of controls falling or falling, maybe you can consider that the trend is looking down, and maybe you can go short in this market with the stop loss at the highs of any of these candles that has a point of lower point of control. So if you had gone short on this market around this level, this on this particular candle, your stop loss will be somewhere around this level. Now, again, we do not teach you how exactly you should put your stop loss, because every person will have a different risk tolerance. So if any trade that doesn't fall under your risk tolerance, maybe you should avoid trading that particular trade. So if at all you take a trade on this particular candle, so there could be a risk of about 80, 70 to 80 points. Okay, so that is the kind of a risk you would have taken. So I do not know where exactly you will take a trade, but consider that you are not looking to take a risk of more than 50 points. Okay, so you would have got an opportunity to trade this particular setup today in the morning itself. So you could have taken a trade somewhere around the high of this particular bar at that time was 34,484, and market touched high of 440 44. So if you had taken a risk of 50 points, you could have taken this particular trade on this particular candle, or maybe on this particular candle. And after that, the market moved almost 100 odd points. So like maybe almost, yeah, 150 points, 140 points it moved. So you'd have given you a risk reward ratio of at least 2 times. Okay, similarly, market made a low out here at these levels. Okay, again, you could have taken uh, a trade when market consecutively traded from the low, 3 consecutive bars higher on the point of control. Maybe you could have taken a trade on this particular interval. There is another setup that we could have traded in this particular interval as well, which we'll discuss later. So again, you could have taken a trade somewhere around with a similar risk of 50 points. You would have got a chance to trade this, because 200 and 300 was a low, 300 was a low. And even if you had taken a risk trade around these levels, so you would have got a risk reward of 1:2 again. So again, market consecutively went to a high here. From there, you can start looking at 3 consecutive candles forming a low, which has not happened here. So probably you could ignore that. Market did a swing low out here. So again, you can see that here also nothing would have happened, because we want to see 3 consecutive point of control from the lows or highs of the day. Excuse me. So this is how you can trade the point of controls. Here also maybe we didn't get a chance. Here we would have got a chance to trade this particular setup. Okay, and market went up after that, one-sided. Market made a high here. Again, market made a year. So this again could have been another trade that you could have taken. However, the risk would have been much higher here as compared to the previous 2 or 3 setups that we saw on point of control. I would like to take questions in between. If at all you have any questions, you can ask these questions on the chat. And again, we will take questions because sometimes you may forget to ask a question regarding a particular setup that I'm discussing. We will answer everything in the end, but if you have any questions, you can ask these questions in the chat. Next concept is the stacked imbalances. Now, let's look at that again. So we see some stacked imbalance, hardly any stacked imbalances today, except in the morning hours of the trade, where the market started much lower and then started forming stacked imbalances out here. Let me zoom this a little bit. So you can see that there was consecutive buying that has happened at the lower levels, which indicates that market was finding good buying support at these levels. And after that, the market has never broken this imbalance today. And this can act as a strong support for the next day as well. Like, whenever, if the market falls, this could act as a very strong support. You can see from the previous session, okay, how these stacked imbalances will help you to identify where there is a strong resistance. So you can see that there was a stacked imbalance happened out here, market corrected, there was another stacked imbalance happened out here. Okay, there was a previous stacked imbalance out here. Okay, and market found support around these levels. Okay, and then again, market recovered. There was a stacked imbalance formed at the high of this particular bar, which is like a trapped buying that has happened. Okay, so when the market broke this level, suddenly you saw a big buying that has happened in this particular bar. So you can see that there was a big buying happened. It was a trap buying. There were a lot of limit order selling out here. And then when the market broke this level, you could always see that there is imbalance forming in a big way out here. So here also you see there is a stacked imbalance happened, and when the market corrected, again it went up to this stacked imbalance levels. There was a resistance around this level. If this resistance was broken, there was another resistance around these levels. Market corrected again, found a support around the stacked imbalance levels, and it ended the day with around these levels. So similarly, if you look at today's charts, you can see that there is a stacked imbalance formed out here. There was a stacked imbalance formed out here as well. Okay, but this was quickly broken. But there were a lot of buying that has happened at this level. So we will discuss this particular setup in detail, why this has happened, and what is the significance of this. Okay, so though market fell, but it didn't fall much. So once the market taken out this particular levels, you saw a big move upside, and continuously market started moving higher. You can see there was a stacked imbalance happened out here as well. So after that, the market has not broken that stacked imbalance for a long time. And again, there was an imbalance formed at the top of the bar. So you have to be a little careful while when the imbalance forms at the top of the bar, which we will show you how to avoid them by identifying if there are big limit orders sitting out there. So see, it happened at this level. You would have been trapped at this level in case if you had taken a trade. There was a stacked imbalance happened out here. Okay, so there was a selling imbalance happened here. Okay, and thereafter market corrected sharply. Next concept is delta volume. So you all know what delta volume is all about and how that reflects in the on the chart. So let me show you that as well. Like if you see the delta volume today, let's look at a current day scenario, which will be fresh in your mind if you have been trading this market. So you can see that there was a good amount of buying happened. There was very limited selling. I mean, there were hardly any selling was there around these levels. Okay, and Thereafter, you saw only positive big deltas. So you can see that the deltas are only positive many of the occasions here. And if they are positive deltas, consecutively the market has gone up with those positive deltas. And the volumes were also quite big, like some of the places 1,300, 981 lots, 1,011 lots, 1,052 lots. Whereas if you see the delta on the negative side, where they were very, very small deltas. Okay, so that is how you could see that you could see that there are the market continuously went up after forming this low today, and we will discuss that why it is formed and what is the significance of it. So the next concept is about cumulative delta. So as I told you, that cumulative delta can be plotted in multiple ways. If you go to the settings, you can go to full chart range. So I always use full chart range. Let's go and apply a daily delta based on daily as well. So let's look at cumulative delta as the start of the day. So if you can see here, this is the start of the day. Okay, let me zoom this. It started with 800 delta on the positive side. So you see a candle. Okay, so you can see some wicks out here, right? So on the candlestick, you'll see that there is a wick. So this is the max and min delta. So this is a max delta. This is a min delta. This is a close delta. So 800 is the delta out here. So this is also 800 is the value. Okay, you can see here on the tooltip, you can see that 800 is a value. Okay, so for the next bar, it is another 317 lots added. So 800 plus 317, it becomes 1,117. So that is how the cumulative delta gets added. So whenever you see a cumulative delta forming a big bar, like say for example, you can see that there was a big negative cumulative delta bar formed out here because of the within no time market started on a positive note, but then started showing some weakness because of these two delta bars. However, the overall strength was that market didn't go below this zero line. If you see this, market has not gone below zero line for a long period of time. So just for few on this particular bar, market went down and suddenly there was a buying came up. So that is the reason you see a big line out here, a big wick on the bottom, and market recovered from there after that, and then market has not never broken this cumulative delta low value. So after that, you saw some kind of a buying happening. If you are good at reading candlestick chart, this candles will give you a good clue about what you should be doing. Okay, so just like how you look at price patterns on a candlestick chart, here you can look at a volume pattern on a candlestick chart. So that is the difference of cumulative delta, and it gives a lot of information for us how exactly you should be looking at whether the like see market corrected a little bit, but the volumes were still positive, so which means that there is a strong buying happening at a lower level. So even if the market is correcting, people are willing to buy at on this correction. So that is why you see that even though market started correcting a little bit around during between this point, okay, whereas the delta was continuously showing positive. Okay, so it was continuously forming positive delta out here. Again, there was a big bounce out here again. So now you see this big, see, if at all you're looking at volume as a price. I mean, if you look at how you look at candlestick on a for a price chart, if you look at volume, so this gives you an indication that this volume is not likely to be broken that easily. This volume is not likely to be broken easily. The low, again, this one big candle out here. There's another big candle out here. There's another big candle out here. So these are the levels where you should be a little cautious about. And if there is a reversal happening, that's when you need to look at market is changing its direction. So here, if you see, there was no reversal happening on the volume side. There was selling happening, but there was no reversal happening on the volume. Every selling that has happened even at this level was absorbed, which means that there is a lot of buying is happening at a lower any correction. So that gives you an indication that the market is likely to go up. But then up to what level? So you also need to understand that once these levels are taken out, there is a possibility of correction. So again, you see that there was a buying at a lower level. There was continuously buying happening. Okay, so now after that year, you can see that again, even market has not broken this low level at all. Okay, so even that means there were a lot of buying happening even on a correction. Even though the market fell sharply, you do not see much change in the delta out here. You can see that there is negative deltas were very limited. Okay, so either there is a short covering that is happening on a correction. We don't know about that, but at least we know that there was no much selling happening from the aggressive sellers. Okay, so next concept that we will discuss is about ratio high and low, which is a very, very important information that you need to look at it. So ratio high. So you have to look at buy setup, positive bar. Okay, positive bar is nothing but close is greater than open. Ratio should be either below 0.50 or above 30. And ideally, there should not be on that particular bar, there should not be delta divergence. Similarly, if you are looking for a sell setup, it should be a negative bar. A ratio should be ratio high. Now, in this case, we are looking at ratio high, and ratio high should be point below 0.50 or higher than 30. And again, ideally, we should not have a no delta divergence. But again, it is a decision one has to take based on the risk reward. So it is, if the risk is very high and the delta divergence is there, so ideally avoid it. But if the risk is very small, you can go ahead with that particular trade. So let us look at some of the trades that you could have taken using this particular setup. So the first thing, I just want to before I do that, I want to highlight what exactly happened on this particular bar. And this was a stop loss hunt. Okay, so very clearly you can see that there is a gap down. There's a huge volume at the bottom of this particular bar. Okay, and this turned out to be the low for the day as well. Okay, so this whenever such a setup happens with the and the market doesn't close this quickly, that means there is some kind of a buying happening, or it can happen on the sell side as well. So this was clearly a stop loss hunt where this gives you a very good opportunity. I think we've discussed in the past as well. If you see such a setup, and if this doesn't close on this particular bar, like if the gap remains like this, so go ahead with the trade on the next bar with the risk below this particular low. Okay, so you could have got a chance to do multiple times on this particular trade. So next came the good setup that came. So you can see that that means there were a lot of buyers were sitting out here. Okay, those who sold at market, there were a lot of buyers sitting out here. And at this level also, you could see that market is not falling, which means that there are a lot of buyers out there with the limit orders. However, the limit orders were not in line with what we really identify through our strategy of a ratio high-low. However, what you can see here is a very good setup for you today, that you could have taken a trade. I don't know how many of you have taken it today, if at all you attended the webinar in the past. So the ratio low was 0.22 here. Close was, this particular candle is a positive candle. So we look at ratio low. Ratio low was below 0.50. Okay, so it's a perfect candidate for buy setup. So you could have gone short with this low as a stop loss in any of the bar wherever you want. and you would have got a good move on this particular trade. So now let us look at how far the market goes after that. So the market continuously goes up to this level. There is no much major limit orders we can see here. There was some kind of a limit order set up out here. So if you had taken, you could have exited on this particular bar, and you could have gone short again on this, because again this particular setup shows you that there are big limit orders sitting out here. Okay, and because the candle is negative, okay, and delta is negative here. Okay, sorry, candle is negative and ratio is 0.35. However, there is a delta divergence out here. You can see here there is a delta divergence. So why, whenever there is a delta divergence happens, you will have to be little concerned about, because market is trying to find a real direction. So here in this particular candle, you can see that there is a positive delta of 22, whereas candle was negative. So it's a choice, like, whether you want to really go ahead with this particular trade. But if you wanted to go ahead with this trade, you would have had a very limited risk also on this particular trade. So thereafter, again, there was another setup out here where you saw there is a 0.36 as a negative delta out here. 0.36 as a ratio here. Okay. Again, you could have gone short on this particular trade. Again, this would have hit the stop loss. Now, I just wanted to highlight why, how we can identify this. So whenever you see a very low ratio or a very high ratio, and if the market breaks around that level, on this particular candle, it broke, right? You can see that in this particular candle, it broke. And around the same level, you saw a huge volume also. Okay. You can see very big volume out there. That gives us a clear indication that this particular ratio high was indicating that there are a lot of sell limit orders sitting out here. This was taken out. This was taken out very, very convincingly. And in the next bar, you can see that there was, and at the bottom, you can see that there is a ratio highs, very highest ratio also. Now, we only go by the 30 and 0.50 ratio. However, this gives us an indication if the ratio high or ratio low is very high, which gives us an indication that there are big limit orders sitting there. Okay, so that is something that, whether it's a positive candle, negative candle, okay, it is very it is, whether it's a positive candle or negative candle, if the ratio low or high are very, very big or very small values, that means there are big limit orders sitting out there. So this is an indication. So as the market is updating, also you get to see this particular information if you closely monitor the order flow cluster charts. So again, there was a good setup out here. You could see that there was again, there were a lot of buying that has happened out here. You can see here, because the ratio is, again, it's not below 50.50, but there is a lot of buying here. There was another setup. You could see here that 0.38 is the ratio high. Okay, there was a correction soon after. Okay, you could have taken this trade for a good 1:2 ratio. There was another good trade out here. Again, this was a delta divergence out here. So, you see more often if there is a delta divergence, the opportunities could be much lesser in terms of profitability. So you'll have to be a little careful whether you want to take that particular trade. Again, there was a buy side ratio low. 0.23 positive candle, but there was a delta divergence, so you have to be a little careful. However, if you had gone with the trades, you can see that there was strong buying out there at the lows, so market didn't break this particular level at all. And why I'm saying this, because if you see here, when the market broke again this level on this particular candle, you see that the large volume happened around this level. That indicates that there were a lot of limit orders sitting out here at this range. Similarly, here you can see that there was a 0.4 and 0.15. Unfortunately, if we go by our logic of taking a trade only if it is a negative candle. We wouldn't have taken this trade at all. But however, this gives us an indication that there were a lot of sell limit orders sitting out there. So, and this market corrected a little bit again, tried to go up here, and market again found resistance because there were a lot of sell limit orders out here. And then after that, the market corrected.